Hey, good morning, everybody. This is Chris Robinson, Robinson Ag Marketing, with today's morning grain comment. We were already open. It's 9:09. Usually I get here a little bit earlier. I want to start off with some of the stupidest stuff I've ever heard in my entire life. Listen to the news this morning. Crude oil is up 86 cents. The person on the news said it's because of the Venezuelan oil blockade. Just absolute insanity and stupidity. And it just reinforces my opinion that the stupidest people on the planet work in TV news and radio news. Complete nonsense. We hit a 5-year low yesterday at 55.20. That was last night's low, excuse me. We took out $55. We traded 54 and change in the spot month. To blame a 60-cent pop on that is it just makes me want to scream. That's all I have to say. We hit 54.98 yesterday. It's the lowest price we've had in 5 years. So the same people that were saying we were going to have $150 a barrel oil when we hit 78 back when we bombed Iran, now they're saying that we rally 60 cents because of a blockade of Venezuelan oil. Venezuelan oil is garbage oil. It's got high sulfur in it. It needs to be cooked a lot to turn into fuel. Don't get me down this. I can't stand the media. Just leave it at that. Moving on to March corn. A little bit higher. We're trying to find a bottom here. I mean, we can't get above the 200-day moving average. We're trading at 438, up a little bit. We're going to see, we're going to play the old low game. I would say get to watch 434. If 434 fails, it's 425. I mean, corn is waiting for some sort of a story to get us out of this trading range. There's no weather issue in South America. We've had tremendous exports, and the market doesn't care. When the market gets really, really good fundamental news and can't make new highs, it always makes me scratch my head. Moving over to the beans, we've dropped $1.14 in March from the high, $11.69 to $10.55. 55 is one of those numbers a lot of people get kind of interested in, excited about. We have filled the gap. We have the lowest prices we've had since October 23rd. I'm going to go ahead and call it, a 2-month low. Can we go lower? Sure. Probably we won't turn until the same people who were screaming about, we're going to go to $14 beans when we were up at $11.60. When those people say we're going to go to zero, that'll probably turn us out. These markets are driven by emotion right now. If I'm looking here right now at beans, if you're buying it here at $10.55, you probably got to risk, $10.34, $10.40 if you're wrong. So you're willing to risk 20 cents if you're wrong. 20 cents is kind of noise at this point in soybeans. We have dropped $1.15, so it's very possible we get a little bit of short covering, especially if we go into the weekend here. Today is only Wednesday. We'll see where we are Friday. I would expect a Whippy Wednesday. Whippy Wednesday, here we come. In the wheat, again, we're making contract lows in March. Chicago, we hit 505 this morning. 505 and 3/4 new contract lows. Defend $5. If you look at KC's hit 503. We haven't gone down and made a new contract low yet. That contract low was back in October 13th at 498 and 3/4. But we're within 6 cents, 7 cents of that. I can't believe we came all this way and we're not going to test $5. Is it going to be a double bottom? Is there going to be somebody writing a book next year about how I bought the double bottom in wheat and made $1 million? Boy, I hope so. I hope it's a double bottom. If I've got wheat in the bin, though, I've got a floor under that because I don't want to be sitting here with another 50-cent gut punch saying, I didn't want to spend 8 or 9 or 10 cents to defend 50 cents worth of downside risk. Now, me saying there's 50 cents of downside risk is not me promising you we're going to break 50 cents. So stop sending me stuff like that. I point out risk. I don't have a crystal ball. If you don't care about possibly losing 50 cents if we continue to go lower, then don't hedge. I could care less. Really, I do. I'm not here to argue. I'm here to try and help people make better cash sales. I'm here to try and help people defend revenue gains. And I want you to hold on to your grain till you can sell it when you want to sell it, not when your spouse or your banker tells you you have to sell it. And I understand prices may get to the point where the outcome, what you can sell it for, does not cover your input costs. I get it. It's happened before in history. It might happen again right now. Right now, you're looking at new crop beans down at 1080. We were at 1130. I wanted to make sure that we defended $11 when we were up there. Are we going to go back down to 1048, which is where we were in October? I have no idea. I would defend what we can. If you're looking at new crop corn, it's hanging in there at 460, 458. There's a lot of resistance up there at 475. What I don't want to do is sit here and do nothing and watch these 26 corn go down and suddenly we're trading at 440 again, or we're back to where we were, around sub 430 when we were back there in August last year. We traded 439.5. So there's 20 cents worth of risk there. Again, if you don't care about the 20 cents worth of risk, don't do anything, right? Looking at bean oil and soybean meal, we've had a pretty good sell-off here in meal. If I'm an end user, I'm looking at this break in soybean meal. We've basically given back half of the rally. March meal's trading at 304. Not that long ago, we were up at 335. So if you're an end user, this is a little bit of a gift. The same way the break in diesel. Diesel hit a 6-month low. Diesel fuel trading 212. Can we go back down to $1.98, which is where we were on the last little dip? Remember that diesel oil traded $1.98 back in May. People forget about that. But 212, the last time I checked, that's a lot better than 270. We were at 270 on November 19th. So if you care about 50, 60 cents, use that as a buying opportunity. Can it go lower? Yeah. But if I'm an end user, it's a gift. Let's move over real quick to the cattle. Fat cattle up 80 cents here today. We've had a $1 trading range, quiet. Feeder cattle up 80 cents. We've had about a $2 trading range, quiet. It comes down to, are we going to continue to push higher in the cattle? Can we get going? What's happening in cash? I keep looking at March feeders. That March feeder cattle, there's a gap up there at 345. We're trading at 338. Can we get $7? I hope so. The big thing I don't want to forget is the fact that we were just down, 3 weeks ago at 293 on November 25th, right? So 293 to 338. That's a chunk of revenue. That's over $20,000 a contract. Take advantage of that. I don't want to be sitting here 2 weeks from now and we're back down sub $3 going, oh boy, woulda, coulda, shoulda. So capture that as much as you can. Set a hedge. I know it sucks that you have to spend a little bit of money to capture that hedge. You either have to buy the put or have to sell the board. But if I've got a bunch of animals out there that are unpriced, you just picked up, like I said, over $20,000 for every contract. That's something worth protecting. I lean towards using long options because once you buy the option, you can't get run over with the margin calls. And let's finish up with the lean hogs. Lean hogs, again, had a tremendous recovery after a $13, $14 sell-off. We can't get April above 90 cents. That's a great recovery. We've stalled a couple times here just under 90, 89.95. We're trading 88.70 today. But again, on November 24th, we were sub 81. We were 81.10, right? We were all worried about going sub 80. So take advantage of the $10 rally. Again, defend. The trade for the next 2 or 3 weeks is going to be very, very choppy, very, very difficult. If you could avoid trading, I honestly would. The only thing I think, if I'm a producer, I want to make sure that I'm taking advantage of this recovery in cattle. And if I'm an end user, I want to take advantage of this break in diesel, also diesel and meal. So use those breaks to your advantage. Defend what you can. This is Chris Robinson. Have a good day.